Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 65, we're going to dive into some issues with a trust as an IRA beneficiary. We're going to look at a recently issued private letter ruling, actually just issued today, that deals with a decades-old question surrounding how exactly do you structure the beneficiary designation of an IRA to a trust under the trust look-through rules. And as we're going to see, unfortunately, this letter ruling didn't really get into great detail in terms of the trust itself, and thus left a lot of questions unanswered, especially around the issue of separate shares for a trust as opposed to naming a parent trust as a beneficiary. Now, as always, this presentation is not intended to substitute for legal or tax advice. So, the IRA trust look-through rules in general are really based on the fact that required minimum distributions, or RMDs, require you to have, in essence, an individual beneficiary with a limited life expectancy. If you do have an individual beneficiary, minimum distributions from the IRA, at least prior to the Secure Act, could be stretched out over that individual's lifetime. Post-Secure Act, you can only get that stretch if the individual is an eligible designated beneficiary, and even then, if they're a child, that stretch may only last until they reach the age of majority, which could be anywhere from age 18 to 26, depending on which definition is used. Now, in all cases, what's generally accepted both before and after the Secure Act is that if there's an entity as a beneficiary, or even a chance that an entity could be a beneficiary, you lose the ability to stretch distributions, and you're stuck with a 5-year rule, which mandates that the IRA be paid out in full, not necessarily in equal installments, but in one final lump sum required distribution that has to happen at the end of the 5th year containing the anniversary date of the decedent's death. So, the trust look-through rules were built into the Treasury Regulations to allow you to basically ignore the existence of the trust and look at the individual beneficiaries. And if you can look at all the beneficiaries of the trust, and we'll look at that definition of all in a second, but if you can look at all those beneficiaries and find the one with the oldest or the shortest life expectancy, in other words, the oldest beneficiary, generally you can use that beneficiary's life to determine required minimum distributions to the trust as a beneficiary. So the biggest problem, as we're going to see, becomes the question of determining that oldest beneficiary, or even determining if there's even a chance that an entity could be a beneficiary of the trust. Now, where this has usually been fleshed out is in some very remote Treasury regulation paragraphs and in an example which really kind of compare and contrast remainder beneficiaries to current income beneficiaries, and really look to whether those remainder beneficiaries, whether vested or contingent, can at least have a piece of the principle of the trust itself. And that'll get into issues of conduit trust versus accumulation trust and how you structure the distributions from the trust itself to the extent that those distributions consist of IRA distributions from the IRA account. So, with all these issues, it's often the case that maybe with a trust, there is an entity like a charity that could become a beneficiary, maybe through a power of appointment or through a remote contingent beneficiary clause, or an estate could become a beneficiary, especially under a revocable trust, because the revocable trust tends to help you avoid probate but can't be used to avoid claims of creditors against the estate. So the estate itself could be a contingent beneficiary of a revocable trust. So for that reason, a revocable trust tends to act as a parent trust, and it's recommended that you not name the parent trust as a trust beneficiary under the look-through rules, because then you have to look at every single potential beneficiary of that revocable trust under the sun. Instead, it's helpful to kind of flesh it out and name individual shares of that trust that are established for individual beneficiaries or family units, as the IRA beneficiaries, and you could use a percent payout as discussed in Private Letter Ruling 2005-37004, or you could sometimes look at by representation or per stirpes types of designations, and those haven't really been tested as much. But in the recent private letter ruling I was alluding to, the IRS did end up condoning a situation where a revocable trust as the parent trust was named as the beneficiary instead of naming the separate shares for children. And ultimately, what happened is the required minimum distribution could be calculated based on the life expectancy of the oldest child trust beneficiary in this case, because the decedent died, named trust as beneficiary, and the beneficiaries of that trust were the decedent's 5 children. So what the IRA custodian proposed was distributing through a trustee to trustee transfer the balance of the IRA into 5 separate inherited IRAs payable to each child's trust, because this revocable trust was to be divided into 5 separate trusts for the children. Now, this is why this is kind of a weird outcome, because we don't know who the remainder beneficiaries of those 5 equal trusts for the children were, nor do we know whether those were structured as conduit or accumulation trusts, or what the powers of appointment were, or anything like that. And we'll get into why that's important in a minute. But the big picture is that the IRS did approve the division here and allowed for a calculation of the RMD for all these trust shares based on the life expectancy of the oldest child. So, as I mentioned, our big problem here, and where we have a knowledge and information gap, is in the question of contingent remainder beneficiaries. So, within the regs, there's this often tossed around term that's not really well defined, and that's the definition of a mere potential successor beneficiary. And where that comes into play is looking at the fact that entities can blow up the RMD stretch, and even an older beneficiary could do so as well. As I mentioned, it's often the case that an estate or charity could be a beneficiary of a revocable trust, which would seem to require the application of the 5-year rule. Now, one thing that could have happened here that wasn't mentioned is that you have to determine beneficiaries of the trust as of 2 dates. One is date of death, and the other is September 30th of the year following the year of death. So it could be the case that maybe through trust administration, the estate or maybe any charity could have been eliminated at that September 30th date. And there's ways to pay them out or get to that point that are beyond the scope of this discussion. But for individuals, there's still some gray areas, and they really relate to the use of conduit trusts as opposed to accumulation trusts for eliminating those contingent remainder individual beneficiaries or entities. And as I mentioned, the private letter ruling didn't really get into this question, and the regs and the example in the regs don't really help us much either, because really what they illustrate is a situation where a conduit trust as opposed to an accumulation trust can be used in spousal planning. And really a difference in the trust distribution standards relates to whether or not the spouse could delay distributions to his or her marital trust until the required beginning date of the deceased spouse, which doesn't really help us in this case. But we still have this looming gray area with contingent remainder beneficiaries, and unfortunately, I have to leave that as a discussion for another time. Now, as always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of The 10th of an Hour, and I look forward to seeing you in the next one.